every 5% dip, I think it was something close to 75% of all 5% dips were buying opportunities in that 2009 to 2020 period. And if you go from like 1950 to 2008, the number was much, just barely above 50%, like 55% of those 5% dips were buying opportunities. A lot of people looked at margin debt for years to tell them when the top was coming, and margin, the idea being margin debt represented a lot of retail speculation. And our view is that retail speculation has transferred over into the ETF market and primarily in these speculative ETFs. A better way to look at yields is not on that straight level, it's how quickly that move occurs. If the Treasury refuses to issue duration, they issue short-term debt instead, then they're blunting the impact of QT. So the bottom line is when we go into these QT periods, I think it's especially important to follow what the Treasury is doing.
So Matt, there's so many people out there in the macro space these days. It's rare to see somebody who does things that are truly unique. And the two people we're going to talk about today, Warren Pies and Fernando Vidal, they both do this. They both have like unique takes. They have data they have that I see from them that I don't see from anybody else. So I think this is really cool that we get to take maybe a unique take on macro today relative to what everybody else is doing.
You just said it. It's a unique take on macro. They use indicators, they have charts, they have graphics, they have ways of explaining things that none of the other macro people use. And I think that's why discovering Warren and Fernando's work here was such a breath of fresh air when I found them a couple of years ago, because nobody else is presenting information this way. This is so cool. And in many cases, really useful because they have actual perspectives that have, they've made some really impressive calls in the last few years.
And so we're going to get through a lot of those unique takes today. We've got clips from we've had them on twice. We had Fernando and Warren on together one time, and we had Warren on by himself one time. So we're going to go through some clips, and we're going to figure out like some of those unique takes and what all of us can learn from it. So we're going to start with a question that Warren kind of alludes to this in the clip, but as much as I would love to do like the 60-40 is dead for the YouTube cover on this and have it like in big red letters, this is a debate a lot of people have had, and Warren's take on it is maybe it's a little more nuanced than that. So here's Warren talking about whether the 60-40 is dead.
I would say that the 60-40 portfolio is dead. No, it's one of those phrases that I think it's a little overused. So it's not really dead. I've heard you talk about that. It's just, I think we went through this perfect regime for 60-40 where we, from a very high level, there was structurally disinflation or no inflation to worry about. So when there's no inflation to worry about in just basically a two variable economy where you have inflation and growth as concerns for your portfolio, you take inflation out of the picture, then every single drawdown in the equity side is going to be growth related, and a growth related drawdown is ultimately good for bonds. And so you had this great environment. One way to see that, we've done a lot of work, just might sneak up on it from a different angle, but I haven't talked about it before, so it's kind of interesting. As we've done a study where we broke down every pullback that the market's had since 1950, anything from 5%, 10%, 15%, and beyond. And what you notice, we pulled a bunch of statistics out of that, and what's a buyable dip, and what should you do whenever the market pulls back 5% or 10%, and your probabilities. And I think there's a lot of interesting stuff in that. But one of the things we noticed was that 2009 to 2020 period, we called that the golden age of dip buying. So I think it was historically, I don't know if I have my numbers correct exactly, but every 5% dip, I think it was something close to 75% of all 5% dips were buying opportunities in that 2009 to 2020 period. And if you go from like 1950 to 2008, the number was much, just barely above 50%, like 55% of those 5% dips were buying opportunities. And when you break it apart, one of the major factors that determines if a dip is going to be just a 5% shallow dip or something bigger is the direction of interest rates during that market stress. And so what we found during that 09 to 20 period, to go to that regime analysis, is almost every one of those 5% dips were met with bond rallies. So you had lower yields cushioning your equity portfolio. And so obviously that was good for risk assets. It was good for your 60-40 portfolio in general. And now what we've seen, we don't have a whole lot of a big timeline to look at yet, but post 2020, post pandemic, it hasn't been, buying the 5% dips hasn't been as good of a proposition.
I think this idea of looking at it in terms of variables is important. So when we had inflation that was low, there was really one variable you had to think about, which is growth. And when growth is the only variable you have to think about, when you get these growth scares, bonds hedge you, you're in good shape. And that went on for decades. When you introduce this other variable of inflation, now you've got a much more complicated system, and now bonds are not the only hedge you need. So I thought that was a really good way to look at it.
When he explains that if it's growth and inflation and you pull inflation out of the equation or off of the table, you have to realize that all of a sudden the way you're going to build that portfolio, the way you're going to think about correlations, all the math on the inputs changes with that thing. So when growth is going to impact stocks and bonds in one way because inflation is not a fear, it has a different impact on the rest of the variables that are in that process of constructing that portfolio. Such a simple observation, but it's incredibly useful. He frequently looks for these, or they frequently look for like these pairs, like growth and inflation together as an input. We're going to get to some others in this. And it's just a really interesting way to just put some nuance back into how do I understand where I am without the hand wavy, like regime analysis only, which sometimes is too broad.
And we obviously can't predict what's going to happen in the future. I mean, maybe we return to that regime at some point, but I mean, it's been a while now since 2020, and inflation, although it's not raging, is certainly well above the Fed's target. It seems like it's going to be above the Fed's target for a while here. So this is something I think investors at least have to consider when they're used to their bonds always hedging them.
Yeah, if the drawdown has to be growth related, meaning the drawdown in stocks is a growth concern related, and that's going to push bonds up. But when you add inflation back, it's going to change that math. It's as important for the drawdowns as it is for the recoveries. And just keeping those in mind, asking yourself about where are we with growth, where are we with inflation, a really useful indicator set.
So I wanted to get Fernando in here early. I am a quant guy like Fernando, and I always see you, like media guys like you out there in your fancy suits, taking my regression that I spent 4 hours to run, and throwing it out there. It's important to get the guy behind the scenes that actually did the work, to do all this in here. So this is Fernando talking about the 60/40 portfolio and the implications in terms of if what we said before is true, what does it mean for constructing a portfolio?
Yeah, it's definitely something that is at like the core of like our approach to building portfolios that include things like commodities and managed futures and all these alternatives, because you're not getting this kind of dividend where you just have this negative correlation between stocks and bonds. So we did some work that I thought was interesting that could weigh into this kind of bond yield argument. But basically when when correlations between stocks and bonds are positive, it leads to a significant step down in the amount of equities that you can justify to reach a certain target of volatility. So like a lot of asset managers are going to look and say, I can't justify this high of an allocation to equities when bonds have these kinds of yields. And, when stocks and bonds are moving together, stocks are just far too volatile compared to bonds. And I need to step down my allocation to stocks because of this correlation change. So it leads to a lot of changes in the way people construct portfolios. You have to rethink, a lot of strategies about using leverage to exploit this negative correlation and boost returns and layer on alternatives. That comes into question when the benefits of this negative correlation disappear. And ultimately, it's an incrementally positive thing for the lower volatility asset, which is bonds.
This idea that when correlations are positive, things change and you can justify less equities. I think that's a really good way to look at it. Because if bonds are not as good of a hedge as they were, then you can justify less equities. And the way you justify more equities is maybe by introducing some of these other diversifiers that offset the problem. So I think that's a good way to look at this overall.
I think it's a great way to look at it overall. And I think furthermore, sometimes we throw around words like risk parity or vol targeting funds and stuff like that. And it sounds like, oh, that's something fancy a hedge fund does. But anybody in the planning, investment advisor, asset allocator world, a lot of the stuff we do is based on some type of risk tolerance. So are you a conservative investor, a moderate investor, an aggressive investor, and all the phases along the way when we think about asset allocation modeling. And what Fernando is getting to the core of, correlations change with these inputs. targeted vol or targeted standard deviations for how much volatility or variance you can allow into a portfolio when you build it, it changes with these inputs. And you really have to step back and ask these questions. I applaud you, Jack, for making sure we get at least some Fernando clips in here because, yeah, the guy is brilliant.
Yeah, and we've looked at this like with our portfolios, and I think it's interesting. So if you start with a stock and bond portfolio, and then you introduce managed futures into the portfolio, what happens is there's a kind of a couple of different ways you can use that. One is just your risk stats get better, like your volatility goes down, your drawdowns go down, and so you could just do that and have a lower risk portfolio. But another thing you can do is you can say, all right, equities might be my driver of long-term growth in my portfolio. So by introducing these diversifiers, I can actually up my equities at the same level of risk I started with in the first place. And that's a place we use it a lot because we're building, portfolios. We're trying to, at least for the long term, versus completely worrying about drawdowns. So using these other things can really help you increase your equities. Whereas he was talking about before, like with stocks and bonds in this environment, you've justified a lower level of equities. Bringing these things in can justify a higher level of equities, which boosts your long-term returns. And I think that's the key point to take away.
Yeah, definitely the key point to take away. You got to do these attribution analyses and you have to understand some of the nuance around it because it can be counterintuitive. And that's why it's important to have somebody like Fernando or you, Jack, explain this to people like me.
Yeah, well, Fernando's a lot smarter than I am.
But it can be counterintuitive. Some of this stuff doesn't seem to make sense at face value, but then when you unpack it, you go like, oh, that's right. And return stacking is another one of those things. Like once it's explained, you're like, oh crap, that actually makes sense. But I wouldn't have thought that way at first.
So I would think people who have watched us and realize how long-winded we are would say we're not capable of a lightning round. But we were going to attempt a lightning round here because, right. Let's get it going here, Matt. Because
let's get the lightning round going. Where's your Jim?
One of the things I'd mentioned at the beginning is they have so many unique ways they look at data, or so much unique data they look at. And so I want to use 3 examples of this. So these are going to be 3 different things they looked at that probably until I had interviewed them, I had never seen these charts before. And they're a unique take on what other people are saying. So let's start. The first one is how they use inverse ETF volume. So here's Warren talking about that.
Yeah, that's an original thing that we came up with. So, a lot of people looked at margin debt for years to tell them when the top was coming. And the idea being margin debt represented a lot of retail speculation. And our view is that retail speculation has transferred over into the ETF market and primarily in these speculative ETFs. We call it the speculative ETF universe. And so that's levered long ETFs like 2x, 3x ETFs and inverse ETFs. So if you're a retail guy and you want to short stuff, you're buying the inverse ETF. So what we do is we take the volume of that entire universe of speculative ETFs and we calculate the percentage of that volume that's inverse. And so the higher it goes, it tells us that retail sentiment is pessimistic, which is a contrarian buy signal. And the lower it goes, it's telling us that there's not a lot of pessimism in the retail space. So as there's a smaller percentage in the inverse ETFs, that tells us that retail is getting optimistic. And the numbers I use, since it's kind of an original thing, it's people are like, how do you orient yourself here? A really optimistic or a really pessimistic reading would be 60% inverse ETFs as a percentage of speculative volume. In a very optimistic world is 20%. That's where we saw the market top back in 2021, 2022 was with inverse ETFs trading about 20% of total speculative volume. And again, we saw that 60% number hit in June of 2022. And it's been a great buy signal to be long since then.
So I really liked what he said there. He said retail speculation has transferred into the ETF market. So whereas people used to use something like margin debt to measure the same thing, maybe measuring like the volume in these inverse ETFs is a better way now because the world has changed. And that's so important with so many indicators. And we're going to talk about that more later. But when things change in the market, sometimes the indicators you use have to change. And I think this is an innovative way of maybe looking at something people have always looked at, but realizing we have to look at it in a new way now.
The best ways to look at sentiment, maybe I shouldn't say the best ways. A very good way to look at sentiment is you can look at self-reported pieces of sentiment. You can look at investor surveys and stuff like that. Or look also at the way people are actually acting. And we see lots of examples for this. You tell me if you remember what the literal word is for what we call these types of sentiment indicators. I can never keep them straight in my head. But when you look at put call ratios, when you look at stuff like this, when you look at this inverse ETF volume indicator that they've come up with, we're actually seeing the way people interact and act around the market. the world's changed. Margin debt ain't quite what it used to be, if it was ever that useful, maybe for different things. This is a really fascinating way to see it. And I don't have a lot of clients or friends who are necessarily trading in these things, but being able to track the volume, we know how popular these vehicles are. So it would make sense that there's useful information in there in tracking their volume data.
And we should mention these are from the fall when we interviewed him. So these are not current charts, but we're more focused on the lesson from the charts than the actual level. Obviously he would have a version of the updated chart, but that's not where we are today. But anyway, so the next one is, this is something you hear a lot, which is, if bond yields break X, all hell is going to break loose. And he has a unique way of looking at this that's not tied to a fixed bond yield. So here's Warren talking about that.
It's not like, you could use 4.5, like 4.5 is a decent rule of thumb. Like we did it's like, this is not a academic back test. We did the back test looking at oil. We said you just get out of the market when oil was above $90 a barrel. You've done well since 2022. And some people who, don't understand what we're trying to do took that as like a very literal thing. But the point is like there's a level where oil starts threatening your portfolio. There's a level around 4.5 where yields have hurt your portfolio. But a better way to look at yields is not on that straight level. It's how quickly that move occurs. So at one point in time, it was 4% and 4.25%, and then 4.5. Now it's maybe 5% where, that level hits. And the way we quantify that is we take a trailing 63-day range and we say, what happens when you get up to like the 80th percentile of that trailing 63-day range. And that's been a good time to step out of the equity market. So as yields have been a new risk to the stock market, that's how we've navigated that, is through this rolling range. And so right now, I think that puts that number's at like 4.61% on the 10-year. So somewhere around 4.6, if we saw yields spike in the next 2-3 months up from 4.3 to 4.6, the equity market would probably start having some indigestion. And I think that's a better way than these like very static levels, but that's how we're doing it, looking at this rolling range.
Yeah, I thought this was an interesting way to look at it. This 5% thing is out there all the time. It's like if the 10-year breaks 5%, look out below, it's going to be a catastrophe. But this idea of using like a rolling average of it and looking at percentiles is a completely different way to look at it, and probably a better way to look at it than just throwing some random like number out there and saying it's all over once we get to this number.
This is one of those things, and this is where, just on a purely simple level, like understanding some basic ways to use moving average and stuff like this. So I think it was a 63-day trailing range on this stuff. What you're effectively looking for is a rate of change puzzle. You're literally saying when this shifts really hard, really fast, people are going to have a hard time thinking about it. And this is another example of, you can't always predict why it's going to shift hard really fast, but you can say in periods where it's shifted really hard, really fast, you better watch out because people are going to have to digest this over about a quarter's worth of time. Just another really cool way to slice the data, and pretty impressively useful the way he paints it.
So the last one, and we actually are doing a decent job of the lightning round here, Matt, I must say.
I know, I'm pretty impressed.
We've actually, I'm impressed by us. So anyway, the last one is this idea, and I've been a skeptic, I think, of seasonality for a long time, and I think he mentions he was as well. But this idea that the market tops in December or January every year. So here's Warren talking about that.
That goes back to that's the stuff. Like I convinced myself there's something to the seasonality stuff. Like, if the market gets out of the year weak, there's less of a chase that builds through the year. So you see a January top or a December top. That's where 56% of market peaks in a calendar basis either occur in January or December. It's pretty crazy. And then we have another chart we show in there. We show the seasonality of each month broken into two parts. So 24 periods of seasonality. And it's funny to see the beginning of each quarter is where you have the strongest seasonality, really, in a strongest seasonal performance for the stock market. So to me, the more I dig into it and just understand the behavioral side of it and how people get left behind in bull markets, I think there is something to it. And this all, of course, assumes we're not going to have some external exogenous event that breaks this bull market, which is always a possibility. And it's why we do all the macro stuff we do. But, without one of those exogenous events, the bull market that's in motion in the second half tends to stay in motion.
That chart is crazy. I mean, that chart even surprised me. Like you've got December and January way up here and every other month, like way down there. So if you're skeptical about seasonality, you have to at least take a second look at it if you see a chart like this.
I remember when he shared the first time I saw him share this chart, whenever that was, some months ago, and just being like, more than 50% of the market's tops and bottoms have it in those 2 months. That might be the wildest seasonality stat I've ever seen. That's not your, presidential cycles one. That's not your months of the year. And then even splitting up the quarters into like the beginning of the quarter versus the rest of the quarter. There's some really interesting seasonality data inside of this that, makes you really feel like that might be some useful information. How do you think about seasonality personally? I know I've asked you this before, but how do you
this is
think?
stuff that's good. It's good. It's good to know this stuff. It's valuable stuff. I mean, I don't think for people who are playing the market on a day-to-day basis, this could be very important. For your average long-term investor, I think it's something that's interesting to know. I think like we've talked about this a lot. There's a lot of things we talk about in the podcast that are not necessarily actionable by people, but understanding what's going on around you is so important in investing that like looking at something like this is important. It reminds me of we're putting our episode out with Larry Swedroe. By the time this comes out, it'll already be out. And like one of the things we talked about with him was this myth of sell in May and go away. And so, yes, it is very, very true that in the May to November period, the market produces worse returns than in the November to May period. But the other important variable to keep in mind is from the May to November period, the market goes up. So if the market goes up from May to November, do you want to sell in May and go away? No, because it actually hurts your long-term returns. So I think that's another example of like when you dig into these things, it's just important to keep them in the context of how it affects you as a long-term investor and what it really means.
Sell in May and just bathe yourself in the shame and guilt and remorse of ruining your financial goals. That's not a strategy. What are you talking about? These things rhyme. We got to believe them if they rhyme.
Yeah, and also like if you think about like last year, sell in May and go away was a catastrophe for you if you attempted to do that. So it also like in any of these things, like there's obviously an average and then there's what happens in the real world. And for an average investor who's sitting here judging themselves on a year by year basis, like these types of things can be challenging because there's a lot of, deviation inside of that, average.
Yeah. And I think the bigger lesson for most investors or allocators is, whereas I wouldn't set your rebalance timing, like cadence to exactly these months or exactly this type of stuff, it can be useful to know there's an outsized chance of wanting to click that rebalance button or take that expected annual distribution or whatever else in some of these periods. That's one useful way that I look at this and go, okay, this is a justification for paying a little bit extra close attention if you've got some of those triggers to either rebalance or take money out, especially for stuff in those periods.
All right, so the lightning round melted down a little bit at the end, but we gave it a good shot.
Listen,
we couldn't get to the third one.
I am holding back so much restraint on quoting all the different Warrens and other things.
Yeah,
There's a lot of Warren Zevon and Warren Buffett, and even an obscure Portuguese poet named Fernando that are in these notes that I am overlooking for sake of this episode. So
I think the viewers appreciate your restraint, Matt. So anyway, we're on to our next one. As people who watch us know, we have a standard closing question, which is, if you could teach one lesson to the average investor, what would it be? So here's what Fernando and Warren said.
Get enough mastery over data analysis to be able to do some myth busting and treat everything that you see out there with a pinch of salt and really try to validate things. And also, like, if anything ever seems obvious in investing, probably not true. Like, if anything, like, such a clear-cut distinction that it's like, obviously I should be all in. Definitely not the case. And in fact, like, that feeling should give you worries. So a deep, deep skepticism is probably the biggest lesson I can impart. And that's from doing a lot of analyses and trying to replicate a lot of things and seeing, how stories take a lot of skeletons in the closet to make compelling and juicy. So
compelling and juicy. It's that quote about the crystal ball and learning to eat shards of glass, if that's how you want to live, right?
Yeah.
A good one.
Warren, what about you? You can impart one piece of wisdom. What would it be?
I mean, to the average investor, which would be like your guy in the street, maybe. I think if you don't do this, like with 100% full-time job, and you need to have the right skills and you need to have the right tools, meaning that you better be able to manipulate data. You better be able to understand the data and spend a lot of time even in the gray areas, that you just really probably should hand the keys over to somebody else who's better able to do that stuff, because it's not an easy game. I see so many people who, I had a guy one time, I'm going to not describe too much about him, but he had made a lot of money in another industry, a lot of money. He was very successful. And he, actually asked me to run his money, and his expectations were to beat the market by, like the hurdle rate was 15% above the S&P 500, every year or something like that. And he had just started out, and, I had a pretty serious conversation with him that this is an unrealistic goal, and why. And so that's kind of the thing I see most often with, I'd say, the average investor, is just a lack of an appreciation for how hard this game is, and that there's a lot of really, really, really smart people grinding at this stuff every single day. And so if you don't love it, if you don't like kind of eat it and sleep it, then best to let somebody else to do it.
I really liked Fernando's at the beginning here. This idea of be skeptical, and if anything seems so obvious, it may not be true. And also, like for me as a quant, the idea of actually look at the data. We hear all this stuff in the markets. Oh, this happens, or this happens, or this happens. Like, actually look at the data and actually understand the data. And so, like, an example of that for me would be the yield curve inversion. So yes, 100% of the time we have a yield curve inversion. Eventually we have a recession. But what can I do with that? First of all, the end of that is almost nothing. There's very few observations. And second of all, it's like sometime between 5 and 36 months, whatever it is, like we might have a recession. Like, it's just important to understand that data, not just take the high level of yield curve inversion equals recession. It's important to dig into the data when you see something like that. So I think that's a good example of being skeptical and trying to use data to challenge what's out there.
Just like a quant, Jack, just like a quant. I'll hit up on Warren's piece. I love this idea of, if it's not your full-time job, maybe get somebody who it is their full-time job. I will sneak one other Warren quote into this. Warren Zevon, not even a quote, just the song "Excitable Boy." Have you ever heard this song? Are you familiar with this?
Not, no.
Weird. All right. It's a really messed up song. And it keeps going back to this idea of this excitable boy and whatever it is. And this is what I think about. Like, if you're the excitable boy and you're just like, I'm going to trade this portfolio, I'm going to do all this stuff, and I don't understand the data or how to do it, you might get lucky, but there might be a horror show waiting just beneath the surface of otherwise a kind of happy-go-lucky pop song. You got to be careful about this stuff. I love this idea. If it's not your full-time job, hire somebody whose it is. Makes me think of that old brain surgeon adage, like you wouldn't perform surgery on your own brain. Like, maybe call in the experts once in a while for the stuff that actually matters.
So now that we've gone to music, I have to go off on a tangent because that's just what I do. So I had to ask you about this because I am like a, more of a casual music fan than you are. But like, I thought Post Malone with Nirvana was outstanding. And I have to see someone who's inside the music like you are. Like, was that as good as I thought it was?
It was great for what it was. It was a beautiful moment in touching memory to somebody that we lost that had a giant impact, and a giant impact on that stage. Because the other thing you have to remember is that the Nirvana performance on Saturday Night Live was really important to them, just like blowing up in the way they did. Not different, or different in its own way, but like when Adele blew up on Saturday Night Live. So it was a really great acknowledgement, I think, of a really special moment. Although I will say, even more than that, I don't know if you saw the Saturday Night Live with Sabrina Carpenter and Paul Simon opening the show.
Yes.
That to me was magical, because we had a current pop star with a pop star from years past actually doing something in full collaboration with each other. Neither trying to, like, she didn't try to outshine him or do any of the other stuff. That was friggin' ridiculous. My wife and I both like welled up on the couch at that performance. And
that was really good. I agree.
But yeah, Post Malone and Nirvana, or the surviving members, back together. It's just cool to see.
So nobody's ever probably transitioned from Post Malone and Nirvana to breath thrusts in a podcast, but we're going to go ahead and do it.
F1 trillion, baby. Here we go.
So here's Warren talking about this idea that maybe the indicators that work in the past may not work as well in the future.
You could just think of the way the stock market has evolved, and from trading off of, digital trading and, high frequency trading, and just the way even stocks are quoted has changed just within the last few decades. I mean, this is a rapidly changing world. And I wonder about this sometimes. Another thing that I think we could probably end up talking about is breadth thrusts. So you see a lot of signals. I remember back when I got into the industry, like put call was a big thing, and put call worked well before the 87 crash. And this is something you learn whenever you do a bunch of back tests, is that if you're going to screen for an indicator, it has to catch these few precipitous declines that we have. Otherwise, it doesn't make your new back test, right? So you have to find things that worked in 1987, which happened to be like put call ratio and 200-day moving average. You have to find things that get you out of the market before the GFC, and if you don't get out of the market before those events, then your back test basically looks like crap and you throw it out. And that's kind of how the industry works. So, I mean, there's been so many changes. And one of the things, like I would say, is breadth thrust. When you see a large percentage of stocks move up together, which we've seen a lot of those recently. We saw one here in the last week. Typically technicians really like that. That's a great signal, but we've had the new advent of zero DTE options and a lot of a different, I'd say, underlying market dynamics. And we've seen many more breadth thrusts over the last year. We had a 20-year period where we didn't get as wide breadth thrust. And now we've had multiple within 1 year. We've had like 6 instances where you would say multiple breadth thrusts since the end of 2021 have fired for the market. And I look at stuff like that, and yes, it's important. We're going to document it and talk about it for our clients. But I think we also need to be honest that, is something changing in the market? Is there something happening under the surface that's making these breadth thrusts more frequent and changing the nature of markets themselves, honestly?
To me, this is something that we have to keep in mind, and we alluded to it before, but like you'll see these things like this, the Zweig breadth thrust. I don't know if you've heard of that, but it's out there. And like when it happens, people are like, we're going to the moon. We've had the Zweig breadth thrust. Get out of your way. And like, it's just not that simple. And also these types of things, as the market changes and the market evolves, these types of things that seemed obvious in the past change. And so I think this was a great example of that bigger principle.
I think it's a great example of that principle. And I'll even raise the stakes one Post Malone on you for this one. This was one of the genius bits of Post Malone. I'm going to blank on whenever the very first song was, the Rockstar song. Whatever his first breakout song was, he basically put their thumb on like the YouTube and the streaming algorithms. So they realized there was this like fluke on the way that stuff was going to count towards the Billboard and some of the other charts. So they literally set up their YouTube videos and other stuff to play like a snippet of the song and loop the snippet to basically put their thumb on the charts so that the song would get suggested and appear in all these other places. This is a version of like breadth thrust. You got to understand how different the availability of different things, the way that time and access changes will create new opportunities for stuff like this to happen. This weak breadth thrust maybe ain't what it used to be, but there's other stuff that's happening right now that might be useful. And we shouldn't get hung up on something from 30 or 40 years ago and overlook what might be useful here and today.
I don't even know how you do what you do, because like you had no idea I was going to bring up Post Malone on this, and somehow you've worked Post Malone into the next immediate thing.
Well, I had to do that
despite the fact you had no clue that I was going to bring it up.
I had to overlook the Warren Beatty quote that I had on this one. But again, we're lightning round.
Yeah, I guess we got to get back on track here. So this next thing is something that I think is very interesting. It's the idea that as the Fed does QT, the Treasury becomes much more important in terms of how they're breaking down their issuance. So here's Warren talking about this idea.
I think the reason that's important is because the Fed's doing quantitative tightening right now. And so our just high level view on QE and QT is that QE works by removing duration from the market, and QT is the opposite, where it would theoretically push duration into the market. And the reason you need to study what the Treasury is doing is because once the Fed starts allowing bonds to roll off their balance sheet and then theoretically push that duration into the market, it's now on the Treasuries in the Treasury, the ball's in the Treasury's court to decide what type of debt they're going to issue to fill that hole. And so if you operate under the theory that you're pushing duration into the market and that's the channel that through which you're impacting policy, then you're not, if the Treasury refuses to issue duration, they issue short-term debt instead, then they're blunting the impact of QT. So the bottom line is when we go into these QT periods, I think it's especially important to follow what the Treasury is doing. I think it's why, maybe it hasn't been as important historically, and now you're seeing everybody look at it because we have what we're calculating out to be about a $2.5 trillion funding hole next year between QT, $720 billion of QT, and then the rest about roughly the budget deficit for the U.S. So we're thinking there's going to be 2.5 trillion that they need to raise. And when you need to raise that much money and the Fed's no longer involved in the bond market, the question is, how are you going to fill that hole? Short-term debt or long-term debt? And so, yeah, the actions of the Treasury have become very important, and they actually take the baton away from the Fed at this point in the cycle and kind of dictate that last mile of monetary policy, how it's going to be implemented and what kind of duration is going to be entering the market or not.
This is just one of those things, and I have to give credit to Andy Constant too, because he was the first person that brought this to my attention. But this is one of those things that when you start digging into the weeds, and it's been one of my things I've liked the most about doing the podcast, is I never would have figured this stuff out. Like when you dig into the weeds of this, you realize that, people who say the Fed is everything maybe aren't totally correct. And when you realize when the Fed's doing QT, it shifts the responsibility to the Treasury to decide, are they issuing short-term debt? Are they issuing long-term debt? And what they decide makes a huge difference. Like if you think about it, just go back to Economics 101, supply and demand. If you're issuing a ton of supply, if they issue on the long side, you're issuing a ton of supply of long-term debt. What happens? The price goes down. What is yield? The inverse of price. Yields go up. So, and when yields go up on the long side, you've got a bunch of implications that, policymakers may not love in terms of maybe the market's going to go down. It's going to affect the economy. So this is just such an interesting thing going on behind the scenes. And as you know, they were issuing a bunch of short-term, on Yellen on the way out, had shifted towards maybe more on the short-term side. And it puts the current administration in an interesting situation in terms of what they want to do, because they have priorities in terms of what they want to see with the economy, what they want to see with the stock market. But by the same token, they just have to balance both sides of this as they think about what they're doing.
Yeah. Remember Operation Twist? Wasn't that fun when all we did was talk
I
about
do
the
remember
Fed
that.
and monetary? Yeah. This whole lesson of actually paying attention to both monetary and fiscal policy, this also feels like one of those things that, whether it's the Scott Moslers or then, the Cullen Roches and the other people, the MMT crowd especially is good at talking about some of this stuff. And back in the financial crisis days, so in 2007, 8, 9, going through that and saying like, well, here's the thing about doing, QE and how this stuff is going to work. And here's why it's not going to work as well without some fiscal component in it. All those explanations, we were in a place in time where, because inflation wasn't an issue, because it was all the growth focused, and because it was all the emphasis of QE was basically going through the fiscal side, we didn't really get to understand the monetary stuff. And it cuts in both directions. So when COVID comes and we basically get rates back to zero and a whole bunch of fiscal stimulus and monetary stimulus at the same time, we see the impact of how much it can turbocharge not just the economy, but the markets that follow it. So understanding how to snap apart these two variables, see what each side is doing. Like the T-back stuff is what, like the letter that goes out once a quarter? It's not like the Fed where we're watching it like it's the end of the Super Bowl, post game show, seeing all the analysis of who did this and who did what and were the ref fair and on sides. That's the way we pay attention to the Fed. Nobody talks about the Treasury like this. This is a really valuable point to make sure you ask those questions. And it's really important, to your point, to track what the Treasury is doing and how they're commenting about this stuff. Do we have that Aaron Stanhope tweet? Are we going to show that too?
Yeah, we're going to put that up right now. And this gets at this idea that this is such a complex game that they have to play. There's so many different variables here, and this sort of plays into Doge. And, rumor has it maybe on the next episode of Click Beta, we might hear something about Doge. I'm not sure. But either way, all this plays into it, because one of the things, whether you agree with Doge or you don't, or you think they actually can do something or they can't do something, one of the things about getting the deficit under control helps with this. It helps with long rates. And so it's just, there's a balance of all these different variables coming in here. And it's just going to be interesting, as Aaron says in the quote, it's going to be interesting to see how this plays out, because this is a challenge. This is like a multi-dimensional challenge that has to be solved here. And it's really, really hard, regardless of your political affiliation or whether you like or don't like certain administrations. It's just a very, very hard thing to figure out. And I think for those of us that are investors watching it, it's better to not look at just the talking points on either side of this and to actually think about the details of what's going on behind the scenes, which is what Aaron's tweet is good for here. And what also these clips are good for is thinking about there's a lot more going on behind the scenes than maybe I know.
Yeah. And you have to go back, especially looking at this tweet from Aaron, where you want to say, it goes back to that growth and inflation thing we talked about at the beginning of this episode. When inflation is off the table, growth is going to make stocks and bonds act in a certain way. When you read these comments in that tweet and you see what an important component inflation is playing in this calculation, what we're watching for as investors and allocators is, are these regulators willing to, or are they potentially going to paint themselves into a corner with this mode of thinking? I don't think that's the case, but I'm going to sneak in one Warren Beatty quote that I did write down on this. If you're going to get married, do it in the morning. That way, if it doesn't work out, you haven't wasted the whole day. This inflation call is kind of that. We got to really watch the way that the Treasury is talking about inflation over the next coming months, because that could totally change their stance on this and determine what QT's impact on the markets actually is.
I'm just happy you and I don't have to do it, because
Seriously, what
I'm
a
much happier to
terrible
sit in the
job.
criticizing seat than the actual doing seat. I think Colin Roche always talks about that with the Fed, is like, we all want to criticize the Fed all day, but like, go to do their job. It's not the easiest job in the world to do.
Yeah, I am glad to talk about my quarterback, but I have been more glad to not actually get hit by a 300-pound man at
That's
full
right.
speed.
That is very true. Yeah, you'd be like, you really should have made that throw when a 350-pound person was barreling down on you. Like, you really should have had that 1 foot to the left. Yeah, no.
Yeah, please, exactly. That scenario all day.
All right, so this next one is kind of in the same vein here, but this is something we asked Warren about at the time, because this is sort of becoming more of an issue now than we've thought about in the past. But obviously, interest rates are driven by fundamentals, what's going on with growth, what's going on in inflation. But then you also have just a simple supply-demand situation going on. So here's Warren talking about that.
Yeah, I think that supply matters. I think that's such a debate out in the market right now, because some like really traditional bond guys will argue that, there's no evidence that supply matters, that the market is so deep, it's going to take this debt down, and that it's all fundamentals. And there was a big debate coming into this TBAC. Like, one side basically said, look, yields have shot higher after the July 31st to August 2nd announcement of more issuance. So that's evidence that issuance is driving rates higher, and demand is falling off from these pools of buyers that I'm mentioning. You have another school of thought who said, no. You see Q3 GDP growth, we're skyrocketing. It's like 5% Q3 GDP growth. Look at Atlanta Fed GDP now. The economy's ripping. Rates are moving higher because of growth. Well, I think that, oddly enough, I think the TBAC kind of settled that debate, with the TBAC being the Treasury Borrowing Advisory Committee, which is a committee that advises the Treasury Secretary on how to issue debt. They write her a letter every quarter when they do these QRAs. And in that letter this quarter, they said they were charged with determining what was causing the rise in rates. And they said it is not growth. It's the fall in demand from those traditional buyer pools. And another way of saying that is that there's increased uncertainty on for future demand. And that's, in bond lingo, a higher term premium that we're seeing in long-term debt. And so when you listen to the government itself, they're saying that the rise in yields has been more attributed to the supply demand factors that you mentioned versus your traditional Fed policy and growth stuff, which I think is the traditional framework for looking at bonds. And that's probably why we've seen so many traditional fixed income guys get caught off sides this year. We've had so many, I'd be hard pressed to see a traditional big bank fixed income person who called for rates to do what they did this year. I haven't seen one. They're almost all bullish, even at like 4%.
And would the logical conclusion from that be, like, when we do get our eventual recession, rates probably aren't going to come down as much as we think they are because the supply is still there?
Absolutely. That's the problem. That's the problem that I think if we get a recession, if the decision that the Treasury made, it saves the day for now. But if we were to get that recession, when you look at your traditional recession, you end up with an additional deficits blow out by, even in a mild recession, like 3 to 4% of GDP. So let's say another $1 trillion of deficit financing in the event of a recession. So we're at a $2.5 trillion hole that could easily become $3.5 or $4 trillion in a recession scenario. And generally, this bills outstanding bills outstanding jumps during a recession, because it's the easiest way for the government to tap short-term debt markets is to fund through bills. So when that recessionary deficit blows out, they pour money into the bills market. And then once the recession goes away and the tax receipts rise, they're able to kind of correct things. But we're going into the recession in kind of an offsides position as a society at this point. And so it absolutely, it does raise a lot of questions on how yields will behave when we go into a recession. Will they come down? Will they come down like they're, according to the traditional script? And how will the government, where will the government go within the debt market in that scenario? Those are all, I think, very fair questions to ask. And if I had to guess, I'd say you're right that yields are not going to come down as fast in a mild recession. We would need a more serious recession, obviously.
This is something I've learned a lot from these guys, is like supply and demand is really, really important here. Again, going back to what I said before, you're issuing more and more supply of debt. Like that supply and the demand of the people who want to buy that debt, that plays a big role in what happens here. It's not just a matter of like whatever's going on in the economy. Now, obviously that supply and demand is impacted by what goes on in the economy, but it's important to think about both of them, I think. Just think about the supply and demand in addition to thinking about what's going on with growth and inflation.
We had this conversation back in the full interview with Warren here. So it's worth going back to hear this, because it's a version of anybody who's, worked their way through finance for a while understands some of the ideas of like habitat theory and stuff like this, which there's supply and demand for different things, but they occur at different points on the timeline. So for example, you're going to have money market investors at the shorter end of the curve. Then you're going to get into maybe like some insurance companies or other needs in the next part of the curve. And there's supply and demand as you go all the way out for who's doing what and for what reasons. And when you start to see the market not just as supply and the demand at the margin for the people who showed up today, but understand the different profiles of the people who might be showing up and determining the price setting that happens at the margin based on supply and demand, you start to see some interesting things. Warren is uniquely able to step back, him and Fernando, and look at, here's the fundamentals, here's how different encampments see those fundamentals, and then what do we think could happen to supply and demand at these different price points on the margin by how they see the world. It's an incredibly useful way to think about the behavior of different investors in different market environments.
And I think with that part we asked him about at the end is really, really important, because this idea that if we get a recession, rates are coming way down, that's something a lot of us believe. But when you look at it as there's the economic fundamentals part of it, and then there's the supply and demand part of it, it may very well be that rates are not coming down as much as we think when we get a recession, because that supply thing still's there. The debt still has to be issued. So when you think about both those frameworks, it could take something that you believe that, if we get a recession, rates are coming way down, and maybe you have to think about that twice, or at least think about it in a different context.
Yeah. And just like we were talking about, read the TBAC notes, read what the Treasury is doing, think about what could they be doing to paint themselves into a corner, but then us as individual investors or advisors, making sure people aren't painting themselves into a corner. Because yes, the assumption that rates could come down might make a lot of sense to us and where we sit, but we have to think, how would these other investors in the space look at the same scenario? There's a lot of spreads of outcomes right now worth considering.
So this next one, again, is from an older interview, so this is not accurate in terms of what's going on now, but this idea that the rally is going to broaden out. I mean, how many times, Matt, have I said the rally is going to broaden out? I mean, at this point, it's like you shouldn't even listen to a word that comes out of my mouth.
You said it 493 times, Jack.
Yeah, I probably have. You could probably ask AI to analyze our transcripts and figure that out. But I have said it a lot, but I like this idea of actually going into the facts and saying, all right, well, what conditions in the past have been present when a rally broadens out? Like, what should we be looking for? What's important? So here's them talking about that.
So the history of these broadening events, and this has been, I think we've all kind of become experts on market breadth over the last year and a half, because that's been the constant push and pull in the market. Is you get these mega cap stocks that run, and then the rest of the market either looks very shaky because now we have this negative narrow breadth, or it broadens out and a big rally ensues. And that's really the tale of breadth that I've found, is that you can have big mega cap leadership and then a broadening out that's positive for the overall market or index. But that process needs to happen in about a 90-day window. And so what we found is that whenever the S&P 500 makes a new high and it's not confirmed by the equal weight within 90 days, that's a negative for the overall market. And so that's something we're watching. It's like, as we, kind of sound pretty bullish about the second half. I do think that you need to see that broadening start to take hold within the next, say, month or 45 days. So to be really exact in the framework of that study, we made a new high. It was the way we classified it as a new high after 21 days of not making a new high in the S&P 500. We made that new high after the sell-off on May 15th. So that's when the clock starts. And we've been, since May 15th, equal weight is basically flat. It's just, it can't get out of its own way. And so by August 15th, that 90-day window, historically, you need to see the equal weighted move higher. Now, it's not that could happen in one day, because we're only like, I believe like 2 or 3% off of a new high on the equal weight. The equal weight hasn't collapsed, but it's just, you need to see that follow through and confirmation at some point. And if we're right about the Fed cuts and the Fed cuts being the impetus for a broadening, I think the timing on all this stuff should kind of work out, where somewhere in the next month, you get the equal weight rallying up, making a new high, and then we can all exhale about this breadth divergence that we've had. But it's like you said, Justin, it's worth watching. It's definitely it could go the other way. If the other 493 break down, it's an inherently weaker market structure.
And when you talk about a broadening, you're thinking more a broadening within like large caps in the S&P 500, right? You're not thinking it'll go all the way down into the small cap area, which is obviously struggled a lot.
Yeah, if I had to be, my honest feeling is that it's just not the right part of the cycle for small caps. And that's, maybe that changes when the Fed starts cutting rates, but I still think that the order is going to go from the uber mega caps down to maybe a few quintiles below that in market cap and quality, and then it'll go in that descending quality and size order, this rally. So I think it's going to be kind of the opposite of a market bottoming. Your traditional market bottoms, high beta, low quality leads off of a bottom. I think in this mature stage of a late cycle rally, the rally is going to broaden in the other direction. And the last group to get moving will probably be small caps. And by the time they start moving, I think it's very likely that inflation's back and the Feds maybe have to make another change and things like that. So it's just not an area where I want to be exposed to small caps, mid caps in this environment. I think there's plenty of meat on that broadening bone and broadening story in the S&P 490, 400, whatever you want to call it. And so that's how we're playing it.
So again, I just like the fact that they have an indicator here. They're looking for like validation from the equal weight, I believe it was, against the market. Like they're looking for something to say, here's something when I tested historically that says this is what leads to the rally broadening out versus, just sitting there and hoping the rally is going to broaden out.
This reminds me of, and it's an old Dorsey Wright thing. So that's, I don't know, either showing my age or showing like, who cares about different weird things anymore. Were you ever a Dorsey Wright guy? Did you ever read any of their stuff or get into any of their stuff?
Yeah, a little bit. Yeah, not a ton.
One of my favorite things, and I remember this because I've been stealing this for years with talking about people when trying to talk about market cap versus equal weight and then stuff like this, because there's a time and a place for using this stuff inside of portfolios when you're constructing them. And I forget which one of the Dorsey Wright guys would say this, but it would be somebody would say to him, should I be invested in how much in the S&P 500? And you go, great, which S&P 500? And everybody's like, well, what do you mean? There's one S&P 500. He's like, well, there's the market cap weighted or the equal weighted. And he had a really compelling relative strength argument for why you would switch back and forth from one to the others based on signals like what they're talking about right here. It's really useful to remember there's more than one ways to skin these things and take this exposure. I also think it's really useful to remember that it's going to ebb and flow, or a pendulum's going to swing back and forth between these. So we've been in this Mag 7 period of where that's going. We haven't really been in that. We need a good name for the other 493. Has anybody named them to your knowledge? Do we have a good name for
Tough to come up with a name for 493 things, but we'll work on it.
The magisterial 493. I don't know. The Jack forehand, the forehand 493. Can we have the Mag 7 and the forehand 493?
As long as it's not like the underperforming 493. That one I wouldn't like. But other than that, I'm good with it.
Other than that, you're good with the forehand 493. So understanding though, there's going to be these trade-offs back and forth. And obviously, just like if you didn't own, I don't know, NVIDIA and whatever pieces of the Mag 7, the attribution analysis show in the last run up, you're a serial underperformer. The thing can be true on the other side. If you're a little bit underweight in the other way, or you have that equal weight exposure, this can make a huge difference in allocator level importance, performance. So it is important, and you do want to track this stuff.
If you could go ahead and get that pendulum swinging though, that would be great. It would just be so much better. Like it's just way over here now. Like just get some a little bit of movement, maybe like a little momentum building in it. Just something would be good.
The forehand 493 will have you with the blindfold on and the pinata up.
I just hope that doesn't stick. Yeah, I really don't want that. I don't want to be associated with it, but anyway. Yeah. So we've got one more clip here as we wrap up, and this is something I've been thinking about a lot, and I know you have, and everybody has. So we had asked him about this, and this is AI. And both from the perspective of how it impacts our everyday lives, but also for someone like Warren who looks at the overall economy, what does it mean for the economy? So we asked him for his take on that.
As far as AI, I mean, I just think you have to give a big air band around what's about to happen. I don't know. Fernando's got his thoughts on AI. We're seeing in our company anecdotally, especially on his end, we're seeing major productivity increases from the use of AI. I mean, his coding has gotten so much more efficient. Like if we have a new chart idea or something like that, he's interacting with AI to help him understand how to best do a data visualization that we've never done before. And it can happen really quickly. Another story I've told is like we have a client who we're redoing some of their models in the background for them. And they wanted, so part of this is delivering charts that in a certain way for them. This kind of goes to this point. They wanted the ability to on the fly change date ranges in a chart. And it's not, I know from my time at my previous shop that it took them years to do this project and they spent millions of dollars. And I mean, again, Fernando's a brilliant guy. So a big part of it is his ability to utilize this, but he was able to take him combined with the AI applications. He was able to solve that problem in like a week just on his own for this client. And so my feeling is that I don't know where this all goes. I have no idea. I'm not like an uber optimist or someone who thinks it's all BS either. But what I can say is if Little 314 research is squeezing that much productivity out of these applications, I would think the top 500 companies in the world are going to figure out how to create efficiencies from it as well. So I think it's going to be a real productivity enhancement tool. It's just a matter of timing. When does that happen and things like that?
Even on a less advanced level than you guys are operating on, like what we do. I mean, I'm always asking myself the question now, can AI do this when I try to do something? And, you know, the description of this podcast, the timestamps for this podcast, like most of that will be 90% done by AI. You know, we had a legal document we had to do recently. Like the first draft of it was AI did an incredible job writing it. I mean, I would think paralegals are in a lot of trouble based on how good it was. Like, so there's just so many things. Like to your point, it's very hard to figure out what all this means, but we know there's going to be significant productivity boosts from this.
Yeah, we had a Chinese hedge fund come on our service. They wanted an agreement in Chinese, and AI wrote it for us. And it's been pretty incredible. I mean, like there's a lot of anecdotes like that I could rattle off. So I don't know. I see a lot of skepticism on Twitter, and I mean, I'm sympathetic to skepticism. Like that's kind of how I'm wired. But I mean, you have to be like a little blind not to see that it's really, there are some real benefits. Whether all the money being spent is actually a good, you're going to return on that, I have no idea, but you're certainly going to get a productivity increase from the technology.
One of the great things I think about this take is there was a lot of I don't know in this take, and I think that's exactly what we need to have in AI takes right now. You'll have people like who are just so strongly said, it's going to improve, productivity is going to change by this, and economic growth is going to change by this. And it's like all of us are trying to figure out how to use this. And when you collectively take everybody who's trying to figure out how to use this and carry it up to an economy, we just don't know what's going to happen yet. We know this is going to be better. I think we know to some degree it's making us all productive, but the economic impact here, we just don't know it yet.
We don't know what it is on a grand layer. We know what it is, or we're starting to understand what it is on a micro layer. And I think that's really important. It seems like, because I know both of us use AI on a regular basis for regular stuff. We use it for creative work. We also use it for just grinding out some of the basic stuff. And this idea, the efficiency and leverage that can come from it. And when Fernando and Warren talk about this is what it enables our firm to do that would have cost millions of dollars just a few years ago in prior gigs. That's the kind of stuff on a micro level. It's a really important and valuable case of what's going on now, but it's impossible to take that and scale that out across the rest of the economy. It's really important humility inside of that statement to realize this is a huge game changer for some of us, but we can't map that across everybody right now.
So the fact that I don't have to do the YouTube timestamps anymore, like how much GDP do you think that's worth?
And this is what I'm saying. You know, that's clearly
lot,
at least
right?
1 or 2 percentage points.
Yeah, exactly. Just on its own. So, I mean, we're getting to Kathy Wood GDP growth levels very quickly here, I think.
It's very,
What was
it's
hers,
very
40 or
easy.
50%? It was a very large number, she said, for GDP growth per year, but I forget what it was.
It was definitely a number where you're like, did somebody lose the decimal place on this? Like, what's just happened? Yeah.
So anyway, yeah, we don't know. And I just think it's really great. I think anybody who's watching us, like, if you don't use it, use it. Even if you don't know what's going on, one of the great things, and I've been working with my dad a little bit to use it, like one of the great things about this stuff is it really just, you can talk to it the way you can talk to a person. Like you don't need Python to go in there into ChatGPT and figure this out. Like just go in there and be like, if I was asking Matt a question, just type in the exact question I would ask Matt and see what it comes back with. It's great from that perspective because it really, like, anybody who can use a computer or can use their phone can use this stuff. And so that would be my takeaway is, like, go out. If you're not using it, go try to use it. Like, there's no downside to it. And you don't need to be like me or Fernando. You don't need to be like, using the API to like access it to be able to use it.
Yeah, you can use it. You don't have to understand or be using it for full on programming, but by all means, we're seeing lots of really smart people apply it in places like that, or marketing or other things where it's a smart thing. My favorite thing about it is that I can talk to it like the way I'd talk to somebody else. Writing a blog post or writing a letter or a note or something for somebody. I can now use this thing and converse back and forth with it the same way that I would do with a traditional editor or with another human, where you're sending a draft to a friend back and forth. Help me work out this paragraph. Help me work out this sentence, or if this idea is clear enough, it should just show up somewhere else. It can do stuff like that. And I don't know what that's worth in terms of GDP, but I know as far as just having access to something that I can go back and forth with, converse with over drafts, it's an incredible thing. And there's probably at least 6 friends in my life who are slightly less annoyed by me now, asking for me to proofread stuff, which is, net benefit.
Yeah, a good example before we wrap up is I was helping somebody I know with like a medical thing. And they had a bunch of, reports that, when you get those, I don't know if you ever go, like, what is the thing you log into where all your medical records are held? Like, I forget what that website's called.
Whatever that database is. But
whatever that thing is, yeah. And you go read those things. There's like all these words in there. You have no idea what any of it means. So like we just loaded it all in there and like asked for like a summary of what's going on. Now, obviously, we're not asking, ChatGPT for like a diagnosis, or we're not asking ChatGPT like which pills I should start taking or anything like that. But when you want to understand what's going on, and then you want to use it, what we did is we used it to generate a series of questions to ask the doctor with respect to medications, with respect to all kinds of other stuff. And that's a great example of where this stuff, like if I took all that stuff, because doctors are they're fallible like everybody else is. Like they can make mistakes. They're talking to a lot of patients. So like the more you can bring stuff together and ask the most intelligent questions with your doctor, the better results you're going to get. And this thing is great at that. Like it really helped a lot in this situation, and it led to maybe us getting, a better outcome than we otherwise would have.
I love that use. I also love, and I think about it a lot. And I think it was Cliff Asness who said this to us, but I've heard other people echo the same sentiment. AI is not coming for your job. It's not coming to take your life. But the thing that is coming for your job is somebody who knows how to use it better than you.
That was Arnott, Rob Arnott.
That was Arnott who said that? Okay.
Yes.
Exactly what you just said. You can be a better patient to your doctor by like doing this thing. You can help your doctor do a better job. You can help your advisor do a better job. I had my first round of a client coming back to me and saying like, this is what ChatGPT said to ask his follow-up questions to this stuff. And you know what? It was really good. And it helped move the conversation forward to putting stuff further into terms that I could help explain some nuance about a Monte Carlo situation that we were running, a couple of different scenarios, and explaining that nuance back to this person in terms they could understand. It helped them draw out those questions that better ones to ask. There's more humanity in that and not less in my book. So I love your doctor example. I love seeing people figuring out ways to use this creatively because, again, it leads to more human outcomes.
So on that note, that's probably a good place to wrap up. Thank you everybody for joining us, and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.